Hi, and welcome back to our edition of Technically Speaking. My name is Violeta Todorova, and I'm Senior Market Analyst at Legacy FX. Asian and European equity markets are trading lower on Monday, ahead of a week packed with central banks meetings. On Tuesday, investors' attention would be on US CPI data for March. The inflation rate for February was 7.9% year-on-year, the highest level since 1982. The market is expecting a big surge of at least 1.2% in March, with consensus estimations sitting at 8.5% and median forecast at 8.3%. Currently, the market is expecting 50 basis points interest rate hikes from the Fed at both the May and June meetings. If inflation continues to rise with its current pace, the Fed would need to hike more aggressively, and another 50 basis points rise at the July meeting cannot be ruled out. The prospect of a more hawkish Fed led to a rocky start to the beginning of the year, with all benchmark US indices still trading in a correction mode since January. The stock market could be in for a rough ride as the Fed prepares to shrink its almost $9 trillion balance sheet. Last week, the Fed speakers had become increasingly more hawkish, hinting balance sheet reduction could begin as soon as next month. This led to steepening in rates and temporary inversion of the yield curve between the 2 and 10-year Treasury notes. The Fed's balance sheet has doubled to nearly $9 trillion as a result of a resumption of asset purchases at the onset of the COVID-19 pandemic. The liquidity provided by an extended balance sheet has been a factor in the stock market rally that followed the short COVID-19 induced bear market in March 2020. The Fed previously moved to shrink its balance sheet in 2017. In a period of 2 years, it fell to $3.6 trillion from $4.2 trillion before a bout of volatility in money markets brought the process to a halt. Given that the recovery has been considerably stronger and faster than in the previous cycle, the Fed expects the balance sheet to shrink considerably more rapidly than in the previous recovery. The size of the Fed's balance sheet and the S&P 500 have been highly correlated. Therefore, the stock market might be facing turbulent times ahead. The S&P 500 has been trading in a correction mode since January 2022, and despite its recent strong rebound, momentum conditions haven't improved, suggesting that the market is not out of the woods yet. The rally from the March 2022 low reversed course, and over the past 2 weeks the index has been grinding lower. Technical traders are monitoring support of 4,444 points, as a break below it is highly likely and would signal an extension of the decline to 4,340 points. Overall, the technical setup and the fundamental backdrop should have market bulls concerned. Thank you for tuning in, and see you next time.